Hi, Jeffrey Haig here, and we're going to look at Chapter 5 of our textbook in this video. Now, once again, before you begin reading the chapter, you have to go through the summary, which is on page 534. There's only 3 learning objectives here. And the basis of this chapter, or the goal of this chapter, is to help you determine what income is, how we determine if something is income, and to see if it is included or excluded from the tax return. So there's steps to do that, and we'll look at those steps as we read the chapter. So going back to the beginning of the chapter, gross income and exclusion. So this is all in one chapter. And we begin the chapter with, what is gross income? And the general rule is that everything is gross income unless it's specifically not. I know that sounds unrealistic to follow, but that's the law. Everything is income unless specifically told to us that it isn't income. So the first few pages goes through what is gross income, economic benefit, if the taxpayer gets a benefit from something, realization principle. That's like the first step when we're deciding if there is income from something that the taxpayer has done. Just because a taxpayer has a house, or a taxpayer, she has some stocks, some shares in Walt Disney, just because they go up in value or the house goes up in value, that does not mean that she's realized anything, because she hasn't sold the house or sold the stock, or she hasn't sold her stamp collection, okay, or her Beanie Baby collection. She hasn't sold those things, so she hasn't realized any income. So that's important to know. At the bottom of page 5-3, they talk about the wherewithal to pay concept. Because if the taxpayer doesn't sell anything, they haven't realized anything, and then there's no way to pay the tax because they have no funds from a transaction that didn't happen. So the wherewithal concept, or wherewithal to pay concept, is important to understand. If you look on the top of page 5-4, there's another principle there, recognition principle. So as I mentioned in my notes, or announcement on the class website, we see if there's a realization first. If something is actually realized from selling my Beanie Baby collection or my stamp collection. Did I realize something from that? Then the next step I have to do is see if it's recognized. Meaning, is it recognized on the tax return? Maybe some of the profit or some of the gain is excluded from being reported. And then maybe some of it is recognized on the tax return. So once again, think of realization done first and recognition done second. And realization comes in the dictionary first, and then recognition comes a few pages later in the dictionary. You can think of it that way also. Realization is done first, recognition is done next. If nothing's been realized, then we don't have to go to the step of recognition. 5-4, other income concepts. Form of receipt, they mentioned barter clubs here. If someone does something for someone else and they do something for them, each of those taxpayers have income, and each of those taxpayers paid someone, didn't pay them, but did something for someone else. So that income has to be reported. And if they did do something for someone else, they would have to show that as an expense. Even though there's no dollars changing hands, they did change services between each other. Return of capital principle, that's at the bottom of page 5-4. Basically means if I paid $100 for a share of Apple stock and I sold it for $105, the $100 is just my return of my capital, what I paid for it, my tax basis. The $5 is what I have as realized income. And then it may be recognized or may not be recognized. So once again, if I bought the share of Apple for $100 and sell it for $105, my gain is only $5. Even though I got $105, the reason I only look at the $5 as being a gain is because I did pay $100 to have that share of stock. Recovery of amounts deducted on 5-5, the tax benefit rule. This happens a lot with medical insurance or insurance from an accident. One tax return, the taxpayer takes the deduction for a medical expense or takes the deduction for an auto accident. The next year they get reimbursed. You have to look to see if they had a tax benefit from taking that deduction in the first year. If they did get a benefit, you'll have to put the income or the reimbursement on the tax return in the second year as other income to offset the benefit they got in the first year. The only times I dealt with this was when someone had they took a large medical expense in one year, and the next year they got their reimbursement of $10,000. So we had to see if they did get a benefit from taking that medical deduction, and they did. We added it back into income the next year. So if you have any questions on that, post that concept. They give a good breakdown of how it works, especially in the example down below, example 5-3. Okay. Not many people know this concept. Okay. But of course, the insurance company or the medical company doesn't issue the taxpayer like a 1099 or tell the IRS that they did get a reimbursement. So it's up to the taxpayer to put the funds back on the next year's return as income. Then going to 5-6, 5-7, the cash method is what most of us are on. Constructive receipt doctrine on 5-7. If I really have receipt of the income, it's really mine. That happens in a lot of cases if you think about interest you get on your savings account. Even if you don't go to the bank to take it out, it's still your income. You do have control over it. That's kind of like in the claim of right doctrine down below on 5-7. These terms are, two different terms, but they're interrelated about what's happening. Constructive receipt, you really have receipt of that income. It's been put into your bank account. So you can go down to the bank and take it out. Even if you don't, it's still yours to be reported. Claim of right doctrine at the bottom of page 5-7 just means that whatever the taxpayer gets, there's no one else that could take it back. It's theirs to do what they want with. Then on 5-8, they talk about who recognizes the income. Assignment of income, it's really who owns the property that's making the income. Whoever owns that share of stock, or whoever owns that classic automobile, whoever owns the house, that's the one that has to report or realize, then recognize the income if something does happen to that property, or that property is making income for the taxpayer. Community property, okay, California is a community property state, so just read that section. It becomes an issue if, when taxpayers file separately. Income usually has to be separated between both taxpayers. And even though we told about married filing separately because one taxpayer, one spouse doesn't trust the other, the spouse is only liable for the tax that's on that return. And if it does turn out later that one spouse did not report all their income, the other spouse can file an innocent spouse relief, meaning that they did not know about it. They did their best to report what they knew, so they can be protected if the other spouse does have tax problems in the future. Types of income, which is our next learning objective, 5-2 on page 5-9, talks about income from services and then income from property on page 5-10. Income from services is what they call earned income. You did some work, you got paid, so you're a W-2 employee, or if you're an independent contractor, you get a 1099 issued. That's earned income. You did some labor, you did some work, it's earned by you. The other type of income that they talk about on that page is the unearned income. Unearned, meaning you just sat around and it came to you, such as interest and dividends. What else do they talk about? Rents, royalties. So that's another type of income that the taxpayer may get. Now, I like to think of income going into 3 buckets. Earned income, W-2 wages, 1099 wages, bucket number 1. Bucket number 2, my unearned income, interest, dividends, capital gains. Then I like to see a third bucket, and you may see this in other books or in future readings, a third bucket that has like rents into it or royalties into it. Even it's still unearned, but rental income, royalty income can be treated differently than interest income and dividend income. So types of income, that's important too because the income can be taxed at different rates. W-2 income can be taxed at 15%, 20%, up to 39%. Interest income, dividend income, specifically dividend income, can be taxed at 0%, 10%, maybe 15%. Also capital gains. We saw in the last chapter that long-term capital gains get a better tax rate. Short-term capital gains get a higher tax rate. So it's important to know what the income type is. Annuities on 511, you can read it if you want, but you don't need to read that. Starting again on 513 is my property dispositions. Fancy word for saying I sold some property. I disposed of it. It can be not only selling it, it could be someone stole my property or it got destroyed, an earthquake or a flood. That's a disposition of property also. Okay? And we'll talk about theft and we'll talk about casualties in later chapters. 513, they give a good formula, Exhibit 5-2, how they get to the gain or the loss of selling a property. 5-14, they talk about flow through entities. That's like a partnership is a good example of that. The partnership up here does not pay taxes. The partnership reports all the income to the partners. The partners pay tax on the income. So the partnership doesn't pay tax. If the partnership gets interest or gets dividends and it rents and it goes down to the taxpayer, the partner, that partner reports the income on their tax return. Alimony, the one paying the alimony gets a deduction above the line. The one getting the alimony reports it as income above the line on the 1040. So you can see what line it is on the 1040, the one getting the income and the one taking the deduction. And the one getting the income has to report where it's coming from, the Social Security number. And the one paying it also has to report the Social Security number of the one getting it. So then the IRS can compare the two amounts and make sure who's ever deducting it, someone else is taking it as income. Prizes and awards on page 16. Okay, there's been a couple postings about that and how prizes and awards are looked at. So read those postings. Social Security benefits, some of it may be taxable to someone, some of it may not be taxable, depending on how much other income they're getting. That'll help depend how much of the Social Security income is taxable. So I hope this is going good for you, understanding what is included so far. Imputed income on page 519. A question probably about the concept of imputed income, but no calculation about it. Just as someone gets a loan from someone else or a company someone's related to gives them a loan below what other people would pay interest rate wise, then there's income that should be reported because they did get a benefit that other people would not get. So that imputed income is reported on the tax return. Even though the taxpayer didn't get any cash, they're paying a lower interest rate than other people would, so they're saving money, so they have to report that difference or that imputed income on their tax return. That goes on for a couple pages and gives you an example on page or example 520. Now, 521, we start looking at our exclusion provisions. What's not recognized. Municipal bond interest, which we saw in chapter 1. Gains on the sale of personal residence on page 522. That's a good exemption. You can exclude a lot of the gain if you have gain up to a certain amount, but you can exclude a lot of the gain from ever paying taxes on it. And this could be used many, many times over someone's life. Fringe benefits. If the company gives you life insurance up to $50,000 worth of protection, that policy is not taxable, or the payment that the company makes on the policies, not taxable. You know, health insurance, some of that may not be taxable to the employee. Having a cafeteria on the hospital premises because they want to keep the doctors and nurses close to the hospital, not taxable income. Parking or bus fare payments to the employees, not taxable. Turkeys, I know that's a stupid example, but gifts at Christmas time, not taxable to the employee because it's too much paperwork to do, too much to try to keep track of. So the IRS gives a lot of fringe benefits that aren't taxable to the employee. And 524, they give a lot there on that page. Okay. And then scholarships. There's a couple of postings about scholarships, so read those. So make sure every time you go into the class website, you should see what's new, what's being unread by you. You should read them. Because I respond to them, other people respond to them. Helps you understand it better. Just don't post and leave the class website. Go read all that stuff. Because that's what we're talking about if we were in the classroom. 525, my scholarships. Like I said, there's a postings or two about that. Most of the time, scholarships is not taxable if you use it for tuition or books. Some cases, if it's paying for room or board or food, it can become taxable. Other educational plans, further down on page 525. 526, gifts and inheritances. For federal tax purposes, if you inherit someone's property or inherit something from a relative or anyone, it's not taxable at the federal level. Some states may tax it. California doesn't tax inheritance. So it doesn't matter how much you inherit, pay any tax on it. The estate or the person's estate that died, their estate may pay tax on it before it comes to you, but once you get it, you don't pay tax on it. Another one they mention here is the gift. Okay, we don't go into that because that's talked about more in advanced courses. Usually if someone gives you $14,000, there's no gift tax involved. And I did post something about that because that was talked about. 527, my life insurance proceeds. The person getting the proceeds from life insurance, no matter, it doesn't have to be a relative, if it's a friend, if it's, you know, whoever gives it to you, it's not taxable to you. Okay? All right. Foreign earned income, just read that on page 528, okay? Because some of us may know people who are working outside the country and they can exclude up to $80,000. It changes every year, but can exclude a large amount of income before being taxed on it. If someone does pay foreign taxes to another country, they get they're able to take a tax credit. We'll talk about credits later. They're able to take a tax credit to offset what they're paying in the United States. For us, being U.S. citizens or residents of the United States, all our income is taxable. Worldwide income is taxable in this country. Other countries don't operate that way. But for the U.S., the law says all my income everywhere is taxable. So I have to report it on my tax return. If I pay taxes to another country, Japan or Spain, I can get a credit to offset how much tax I have to pay in the United States. Foreign income exclusion. There was a case a couple years ago. Someone worked in Antarctica. I'm not saying that right, but Antarctica. They worked down there in South Pole. The government said that's not a country, so all that income is reportable. None of it's excluded. Okay. Workers' compensation on 529, payments with personal injury, healthcare reimbursement, disability insurance. So all these, in most cases, are excluded from income. Deferral provisions on 531. A couple of those, as I mentioned, installment sales. I get payments little by little over the years. I defer that gain as I get those payments in the future. Retirement accounts. Some of my retirement account income won't be taxable until later, or it may not be taxable at all, depending what type of retirement plan it is. 531 gets a good example of my income summary. So look at that, and then on page 532, there's my 1040, just part of it. And you see it's everything between line 7 and line 21 that they're showing all my income. We'll talk about deductions more later. But there's all my income items. Okay? See where it says other income, line 21? If you can't fill it somewhere else, put it there. I put gambling winnings there. I put, miscellaneous income there. Okay? So stuff like that, report it there. One time a student gave me $100 for Costco, I don't know, as a gift. I reported that as miscellaneous income on line 21. Okay. Then I know you're saying gifts aren't taxable, but it was really a situation of he did give me this $100, probably because I did help him through some tax questions that were more related to his personal life than what was going on in the classroom. So I did report that as income. The worksheet for Social Security is on 533. That's the form you would fill out if you do it by hand to see how much my Social Security income is taxable. Key terms. I wrote some key terms on Blackboard for this chapter, but I'll probably go through them all again here. Alimony is good to know. Assignment of income doctrine. Claim of right doctrine. Constructive receipt. Earned income. Unearned income, I like those terms. Flow-through entity, fringe benefits. Imputed income, like I said, no calculation to do. If it's on the quiz, just the concept. Non-recognition, realization. And then there's two more. Tax benefit rule, and then the wherewithal to pay concept. Okay. Discussion questions, a couple discussion questions I think are good. Of course, you can choose any one to talk about and put it in your own words, because I know if you've cut and pasted a definition from somewhere, or if you got the solution from somewhere, I can tell that it's just cut and paste. Don't cut and paste anything. I know when it is that way. Talk about it in your own words. Or if you're going to cut and paste it, talk about it down below in your own words, how you describe it to someone. Question number 1, question number 3, number 4, number 7, 9, 10, 11, 12, 13, all good questions. Then 16 and 18, 25, 28, and 30. I think those are good questions to look at. Okay? So the homework problems are there. If you have any questions on the homework problems, post them. And I hope this video has helped you get through this chapter 5. And I will see you again in chapter 6. Thanks.